Ari Bergmann is one of the original derivatives guys, folks. He ran the derivatives desk at Bankers Trust, and he helped open up the credit defaults market back in the mid-1990s. Now, this is the time of year, when people tend to do two things. They like to make lists, and they like to look ahead into 2011. Ari has decided to do both. He's put together a list of risks for 2011. His firm, Penso Capital Markets, advises on risk for more than $200 billion, and Ari is teaching a course on financial risk management at New York University. Ari, at this time of year, the kinds of lists that I usually see are lists of presents. You've got a list of risks. Let's talk about what to expect in 2011, and most importantly, how to prevent yourself from getting bitten.
Okay. Thank you, Erik. There are tons of risks out there. I mean, you've got to invest, and you've got to watch the risks. First and foremost, Europe. We've got to see what happens with Europe.
So the sovereign debt crisis is what we're talking about here.
The sovereign debt crisis, exactly right. We perhaps have some kind of a rescheduling of that coming. It's a solution that we're just getting the can forward.
I have to interrupt you here, because so many people, particularly European policymakers, want us to believe that there will be no restructuring of debt. Restructuring, rescheduling, whatever you want to call it. Maybe they're right, maybe you're not. Are you telling us that you need to be prepared for one either way?
The risk is that you will reschedule the debt, and when somebody defaults or reschedules that, it's a serial event. Not one guy does it, but everybody does it.
Like what happened in Iceland, for example.
Iceland was an isolated case, but look at Latin America in the 80s. Everybody, one guy decided to reschedule or to renege on the debt, and everybody followed
after that.
Absolutely.
So, what's the, let's put it this way. You're in the business of risk management. You're not actually investing people's money to make money. You're investing people's money to prevent losses. So if you look at the sovereign debt crisis, how do you respond?
You got to find mispriced risks to take a good advantage. CDSs are very, very dangerous right now because they might be outlawed. You might be protecting yourself with an instrument that won't work.
Not to mention they're expensive.
Absolutely.
So how do you do it?
You have to look, don't focus in the epicenter, focus in the aftershocks. You don't focus in the countries which are the first ones on the list, like Greece and Ireland. That's there already. Look at what's the next wave. Who are the next countries? Where is the ball falling next? If it's a serial event, who is coming afterwards?
Okay, so that is the sovereign situation in Europe, one that we're all, the risks of which we're all familiar with by now. Let's talk about the other sovereign situation, the one concerning the United States and quantitative easing. How do you see this playing out, again, when we're considering risks as opposed to necessarily predicting the future?
I think we have two risks. One of them is municipalities. We have our own little Europe here in this country. So we might have some municipalities also in the serial event trying to reschedule the debt as a political tool. And that's one. And I think there's a second one, which is the Fed. What happens around Paul running the Fed might be an interesting story.
Ari, everybody wants to make money. But as we learned during the financial crisis, you really can't make money in the long term unless you're aware of the risks. We were talking earlier about the risks of the sovereign debt crisis in Europe, and you mentioned some of the risks that we need to be mindful here of in the United States. Number one, what happens with quantitative easing in the Fed and the muni market. Why don't we start with the Fed? Tell us what you see.
I see that the Fed has taken very strong actions, and I think that now we're going to hit bumpy roads. Perhaps yields will go much, much higher because people will expect the Fed to finally tighten.
When you say much, what are you talking about?
200 basis points.
200 basis points on the 10-year yield?
On the 2-year yield.
On the 2-year,
People are focused on the 10-year yield, but people are forgetting that the 2-year yield is the one that moves the most when the Fed comes to go and tighten.
Of course. So we could see 2-year yields rise by 2 full percentage points, in your opinion, over the course of next year, or at least that's a risk.
That is the risk.
Now, what else? What else concerning the Fed and quantitative easing? Is this a direct consequence of QE?
No, I think the QE just raised the stakes. Now we are going full force, full throttle. If you have to pull the brakes, it has to be that much stronger and that much.
Okay, so how do you hedge? Let's say you have to hold treasuries. There are lots of people who have to own treasuries. You don't want to get caught offside if this kind of thing happens. How do you protect yourself against a move like that?
Again, you always have to look at mispriced risks out there, and there are plenty. In the yield curve, both in the yield curve in the options, in the yield curve trading, and in itself in the OIS market.
All right. Well, unlike credit default swaps on Spain, for example, some of these hedges do come a little more cheaply. Let's talk about what's going on in the muni market, because for ages now we've heard of an impending collapse in U.S. municipal debt. It hasn't happened thus far. There are definitely some shaky municipalities and shaky borrowers, but the assumption is that the federal government will come in and backstop them. I take it your thinking is that no, that's not necessarily going to happen.
Perhaps it might not happen. And perhaps it might be very politically expedient to just let the investor suffer. And therefore, you might have, right now, we had some shaking in the muni markets, but it might be much worse. And you've got to look at it and realize that we have shaky and very fragile finances.
Okay, so munis, much harder to hedge. First of all, there are all kinds of issuers. We're not talking about one single entity, i.e. the U.S. federal government. How do you hedge against that?
Again, always look at the markets, find mispriced risks. Again, plenty of them in the muni markets. You realize that there are many issuers and many maturities. Find what is interesting and what's available to hedge. But don't use CDSs. CDSs against municipalities might be outlawed also.
Well, there's, as you well know, big concern from Bill Lockyer, for example, the California State Treasurer, over whether or not CDS should even be allowed in the municipal bond market. I want to get to one other question, though, before we run out of time, which is if you look across the globe right now, are any of the risks that we just talked about the single biggest risks in your mind, or is there perhaps something even greater?
I think the biggest risks are always the unexpected, like this year. And I think that risk is perhaps geopolitical. We are sitting in a lot of problems, both in Iran and in South Korea.
You're beginning to talk like George Soros here.
And you've got to watch it, and you've got to hedge it, because anything that you plan ahead usually is not the worst. What you least expect, it all bites you.
Okay, so the powder keg blows, for example, in North Korea. It's going to suck in China. It's going to suck in the United States. The same thing might happen in Iran. There's Russian interests at stake. There's all kinds of peripheral interests in Central Asia and the Middle East. You know, how on earth do you go about insulating your portfolio from that kind of damage?
Again, find what's out there. Don't focus on the markets.
But it's not easy. I mean, give us the benefit of your expertise. Where do you go to find this stuff?
Life is never easy. Just think to yourself, okay, if this happens, what will move? What's the aftershock? And focus on the aftershock, because the market does not price the aftershock. The market focuses on the risk. It's expensive, but don't look at that. Say, okay, if A happens, how is B going to react, and let me hedge B instead of A.
I see. Focus on the correlation. All right, Ari, it's always a delight to have you here. Ari Bergmann of Penso Advisors.